Imagine a company that promised to change not just how we work, but how we live. A company that turned office rentals into a global movement, complete with glass walls, kombucha on tap, and a mission to elevate the world's consciousness. That company was WeWork. In just under a decade, it skyrocketed to a $47 billion valuation, one of the most hyped startups of the 21st century. And then, just as quickly, it collapsed into bankruptcy, leaving behind a cautionary tale of hubris, hype, and harsh financial reality. This is the rise and fall of WeWork, the birth of a new idea. WeWork's story began in New York City in 2010, founded by Adam Neumann and Miguel McKelvey. Their vision was simple yet powerful. Take big, long-term office leases, redesign them into trendy, flexible spaces, and sublet them to startups, freelancers, and eventually corporations. The idea wasn't just about renting desks, it was about creating community. WeWork wasn't selling office space, it was selling belonging, collaboration, and lifestyle. Early on, this pitch resonated with the generation that hated cubicles and wanted flexibility. Instead of committing to a 10-year lease, startups could rent space month to month. Freelancers could find not just a desk, but a network. For a time, WeWork seemed like the future of work, the rocket ship valuation. By 2014, WeWork was valued at $1.5 billion. Investors loved the story, and growth looked unstoppable. The company expanded aggressively, opening locations in major cities worldwide. With its glass walls, stylish interiors, and cold brew taps, WeWork became synonymous with startup culture. Its brand promised not just an office, but identity. Then came the game changer, SoftBank's Vision Fund. Masayoshi Son, famous for bold bets, invested billions into WeWork starting in 2017. With SoftBank's backing, WeWork scaled at breakneck speed. By early 2019, its valuation peaked at a staggering $47 billion. Neumann spoke about making WeWork a physical social network, comparing it to Facebook and Uber. To investors hungry for the next tech giant, this narrative was irresistible, selling a dream. At its peak, WeWork wasn't just a landlord, it branded itself as a tech company. It promised exponential growth and cultural transformation. Its mission statement, to elevate the world's consciousness, bordered on spiritual. Neumann cultivated an image as a visionary leader, blending charisma with grand ambition. He claimed WeWork could solve global loneliness, reinvent education, and reshape cities. This wasn't just hype, it was strategy. By presenting itself as a tech disruptor, WeWork justified valuations far beyond traditional real estate companies. For a while, it worked. As long as venture capital flowed, the losses seemed irrelevant. Growth masked the underlying risks, the fatal flaw. But beneath the glossy branding, WeWork's business model had a problem. The company signed long-term leases, often for decades, while offering customers short-term, flexible memberships. When demand was high, WeWork thrived. But if demand slowed, the fixed lease payments remained. It was a risky mismatch. Long liabilities, short revenue streams, and the company was burning through billions each year to expand. Investors overlooked these red flags as long as the story dazzled. But when WeWork decided to go public, the illusion shattered. The IPO disaster. In 2019, WeWork filed for an IPO. The S-1 prospectus revealed the truth. Massive losses, questionable governance, and an almost cult-like culture. Adam Neumann had super voting shares giving him near total control. He'd engaged in controversial deals like personally owning buildings leased back to WeWork and even trademarking the word "we," which he sold to the company for millions. The prospectus read less like a financial document and more like a manifesto. Phrases about elevating consciousness clashed with the billions in losses. Public investors recoiled. The media mocked the filing. Analysts compared it to a house of cards. Within weeks, the IPO was delayed, then scrapped. Neumann resigned under pressure, and WeWork's valuation plummeted from $47 billion to under $10 billion almost overnight. SoftBank's rescue. With the IPO dead, SoftBank staged a rescue plan. It pumped billions more into WeWork, installed new leadership, and tried to stabilize operations. But the damage was done. The dream of being a $100 billion tech giant was gone. WeWork had been exposed for what it really was, a real estate company with tech-style ambitions. Still, SoftBank tried to salvage value. It bet that with discipline, WeWork could grow sustainably. But then, another crisis hit, one no one saw coming: the pandemic blow. In 2020, the COVID-19 pandemic turned WeWork's model upside down. Offices emptied, remote work became the norm. Companies slashed costs, and demand for co-working space evaporated. WeWork's core product, shared urban offices, suddenly looked like a liability. The company scrambled to renegotiate leases, cut staff, and conserve cash. But the pandemic exposed just how fragile its model really was. The SPAC gamble. In 2021, WeWork made another attempt at going public. This time, it merged with a SPAC, BobuX Acquisition Corp. at a much lower valuation of around $9 billion. It raised fresh capital and tried to rebrand itself as a leaner, post-pandemic company focused on enterprise clients and hybrid work. For a while, it looked like a second chance, but SPAC hype faded, and WeWork still couldn't escape its heavy lease obligations. The world of work had changed. Hybrid schedules reduced demand, and rising interest rates made debt more expensive. Losses continued. By 2022, investors once again doubted its survival. Bankruptcy reality. In November 2023, WeWork filed for Chapter 11 bankruptcy. Once worth $47 billion, the company's market value had collapsed to less than $50 million. Bankruptcy allowed it to shed billions in debt and exit hundreds of unprofitable leases. It was a brutal but necessary reset. WeWork emerged from bankruptcy in 2024 as a much smaller company. It canceled leases, slashed costs, and handed control to creditors like Yardi Systems. SoftBank, once its biggest backer, saw its investment nearly wiped out. The new WeWork was no longer a visionary rocket ship. It was a cautious, trimmed-down operator trying to survive. Adam Neumann's second act. Even as WeWork collapsed, Adam Neumann landed on his feet. In 2022, venture capital firm Andreessen Horowitz invested $350 million into his new real estate startup, Flow. The move sparked controversy. How could a founder who presided over one of the biggest startup failures still raise such a massive check? To some, it showed Silicon Valley's obsession with charismatic founders. To others, it was proof that the lessons of WeWork hadn't been learned. Lessons from the fall. So, what can we learn from WeWork's rise and fall? First, narrative matters, but it can't replace fundamentals. WeWork sold a dream, but the numbers didn't add up. Eventually, reality caught up. Second, timing is everything. In an era of zero interest rates and cheap money, risky models can thrive. But when conditions change, those risks are exposed. Third, governance matters. WeWork's structure concentrated too much power in one founder's hands. Without checks and balances, vision turned into excess. Finally, not all industries are tech. Labeling a real estate company as a tech disruptor inflated expectations beyond reason. When the bubble popped, the fall was inevitable. The legacy of WeWork. Despite its collapse, WeWork left a mark. It popularized flexible office space and forced landlords to innovate. Today, co-working is mainstream, and companies of all sizes see value in shorter, more adaptable leases. The idea worked, the execution did not. The new WeWork, smaller and more disciplined, might still carve out a role in the future of work, but it will never again be the $47 billion juggernaut it once claimed to be. Its story is a warning to investors, founders, and dreamers alike. Hype can build fast, but it can collapse just as quickly. The neon signs still glow in some WeWork offices, the cold brew still flows, and teams still gather around communal tables. But the dream of elevating consciousness has been replaced by a simpler, humbler goal: paying the rent. The rise and fall of WeWork is more than just a business story. It's a parable of an era when ambition soared higher than the spreadsheets could support. And in the end, no matter how inspiring the mission, the fundamentals always win.